Hello, this is MJ. Let's talk about the long term equity in the market. This concept of the long term equity must be quite confusing, right? It is like in the sliding scale, depending on what you're investing in. For some of the mutual fund investors, investing for more than 5 years would be the solid long term investment. But for some other investors who are basically the traders, investing for less than 1 year would also be the long term investment. See, the savvy investors do understand that you need to stay invested in the equity market for a long period of time, as long as humanly possible and sometimes forever. It is like having a marathon mindset in the equity market. Everybody talks about the diversification, they talk about the allocation, they talk about the power of compounding. But one thing that they miss out to talk about is a long term investment. Long term investment is a recipe for the investment success. Long term investment is like an unsung hero. Long term investment is a risk management which will create a wealth over a long period of time. Investing is just not about making returns, it's just not about making money, it is about protecting it too. It is about mitigating the risk. I cannot emphasize more than this is that first understand the risk and then about the returns. Yeah, I cannot be more true than this. So, what is this risk? It can be the sovereign risk, the operational risk, the business risk, the market risk, the interest rate risk, the inflation risk, the credit risk, etc. And these risks will create the volatility in the market. Managing this risk and volatility is a big deal in the investment success. It is like this roller coaster ride, those ups and downs, and this ups and downs is going to help you create wealth in the longer period of time. So that is the sweet thing about the wealth creation in the equity market. But there's a catch here. When there is a down, many investors they tend to take those impulsive decisions which will be very detrimental for them in the long term wealth creation. They cannot withstand that short term loss. They exit prematurely, which is not good for their portfolio, which is not good for their wealth creation. Let's look at a chart where the various investors have invested in the various time period and how that investment has performed. Let's look into the positive probability of return and the negative probability of return if they have invested over the course of period of time. Now, for example, if the investor has invested for 1 year, the probability of positive return is 70. For 3 years, it is 85.4. For 5 years, it is 93.9. For 7 years, it is 94.8. For 10 years, it is 99.7. Let's look at the probability of the negative return for the first year. First year it is 30%. For 3 years it is 14.6. For 5 years it is 6.1. For 7 years it is 5.2. For 10 years it's 0.3. So from this chart itself, we can understand that if you hold your investment for a longer period of time, the probability of positive return is 99.7 and the negative return probability is nearly zero point 0.3. So it cannot be more true than this that holding your investment equity for a longer period of time will help you create a wealth. Standard deviation is a glorified word to measure the volatility in the market, is those upswings and the downswings. The cool thing is that if you stay invested for a longer period of time, these wild swings will lessen. Let's look into the Nifty 50 chart for 1 day and the 5 years. One day when you look at it, these ups and downs will be scary for some of the investors. But when you look into the 5 year chart, this downside would be merely the blip in the smooth curve. So equity investment is nothing something which will give you the linear growth over the course of period of time, but all those upsides and downsides which will finally get into the growth aspect to create your wealth creation. There may be a lot of people who will be telling you be patient, hold on to your investment for a long period of time, maybe 5 years, 3 years, and all that. But seriously, is it patience that will help you hold your investment for a longer period of time? I don't think so. I believe that it's more about the conviction. You have made your investment plan, you have decided to do the investment as per your investment plan, and you stick to that investment for a long period of time during this ups and downs. That's a conviction, that's a confidence that you have in your investment, and that will help you to hold on to your investment for a longer period of time, and not patience. Patience obviously is one of the important factors, but conviction plays more priority role than the patience. It is conviction that is going to hold on to your investment for a longer time. Patience is something like you don't know what you're doing, you just don't act on it, and you'll just remain clueless about your investment. But conviction is more about what you think, and patience is more about what you act. So conviction plays more important role in your investment in the long haul than the patience. So, the success of the equity investment is staying invested for a long period of time, sticking to it during thick and thin, having a solid belief in your investment plan and decision, and that would be the game changer, and that will help you create a wealth in a longer period of time. Signing off, MJ.